Assalamu alaikum. Welcome to question number 16 of ATX revision kit. The reason I've I've jumped from question 4. I've done the first 4 questions from the revision kit 1, 2, 3, 4. And the reason I've jumped to question number 16 straight away is because this question and the next question that I'm going to solve, question number 19, are on the request of a member of my YouTube channel. She has requested me to do two questions, question 16 and 19, just before the March exam. So this is on her request. Then I have started with question 16. Now, so this question is a group question. It's a very good question because we have not touched group question in the previous 4 questions. Previous 4 questions was on unincorporated businesses. Okay. In fact, the first 9 questions of your revision kit are on unincorporated businesses. After that, we are moving on to the corporate businesses, groups, companies. Okay. Here we have lots of things to do. Question 16 is a lengthy question. It has a lot of requirements in it. So do not panic. We'll slowly break down this information into small pieces and then we'll solve this question. So here, basically to get an overview of what this question involves, we'll go through this list. This will help you to plan out what's there, the topic wise. But make sure that you read this question in full, and at least you have attempted this at least once before you watch this video, so that this is like a debrief of your question and it helps you to understand where your mistakes are, rather than expecting me to read this entire case study and then it wastes a lot of time. So let's start with the works. So here we have a capital gain group. That means we are going to have some losses here which we have to settle among the group. Okay, group planning for capital gain loss. Next, we are transferring of trade and asset within the group. This is something new which is usually not asked. Next, corporation tax. There was an understatement of corporation tax by the group. This is ethics. Something overstatement, understatement is usually ethical question. Then we have income tax saving for various investment options. Then we have inheritance tax, a gift to non-domiciled spouse. See, in ATX you will have this non-domiciled resident and all. Okay. Capital gain tax from gifting a part of property before the sale. So how many taxes are there? It has multiple questions: capital gain tax, inheritance tax, income tax, corporation tax, tax losses, ethics, transfer of trade and asset. It has multiple topics under one question for 50 marks. Okay, so now you have 3 exhibits. Exhibit 1 is for the group, 2 D and CAM, 3 is your requirement that you need to carry out. And already you have been given today's date as 1st June 2024. You need it. Okay, you are a manager, so your manager has asked you to do this work. Now, before we start with the requirement, exhibit 1 and 2, I will straight away take you to exhibit 3 to go through the requirements. Always start by reading requirements first and then come back to the case study, so that you know where you have to exactly mark. We know we need exhibit 1 for part A, we need exhibit 1 for part B, exhibit C for 1 for part C also, and then from D onwards we need 2. So you know what you need to read exactly. E, that's it, there E. Okay, so these are basic information that's always repeated in any exam, so I'm not going to waste time to read. These are the marks, 10 professional marks and all those things. Okay, so now always go up and check in exhibit 3 what requirement, what is the format that you are asked. That is your starting point. So you are required to prepare some notes and guidance. Good. Why? Notes and guidance does not have any format. You can start with directly the subheadings. You can pick up these headings from here itself. Group planning. Then what's next? Group restructuring, disclosure of transfer pricing. You can directly pick this, copy paste it and write it in your answer as subheading, because it's just notes. Okay, so first I'm going to finish with part A, group planning. Okay, See, sometimes in group planning, you are open. Open means you can use multiple carry forward, carry back, terminal loss. Sometimes you are restricted to certain choice. They might give you an objective. That means you have to use that specific thing. You can't choose. Like in this question, examiner has told you specifically. For example, the group objective is to minimize corporation tax payable in installments by the group companies. Group companies can pay in installments, right? Because group companies are usually big companies having huge amount of taxable profit. But here, objective is to minimize corporation tax by installments for the year ended 31st December 2024. So now, to do that, these are the 1, 2, 3, 4 things you have to do. Make sure that you write this in order. Do not jumble. When you're writing it, it has to be in order. First you have to do this, then you have to do this, then you have to do this, then you have to do this. In your word processor, response options are two. Word processor and spreadsheet, the Excel. You can use, obviously you need the word processor to write all those things. So the first question, the circumstances in which the member of the group would be required to pay. First, you have to understand the circumstances in which they have to pay corporation tax in installments. Assuming the profit threshold should be divided by 18. I will tell you why it's 18. Because there are groups, 18 associate companies. That's why. When we go to exhibit 1, I will show you. Okay. Next. Circumstances in which you have to pay in installments. Okay. So your profit threshold, whatever your profit, see, you need a profit threshold, right, for installments. Know your upper and lower limit for corporation tax that you have to divide by 18. Next. Which companies are members of capital gain group? Very good question. You have to identify here which are the members of capital gain group. Third, how the company should determine the amount of chargeable gain and capital loss to transfer between the group companies. See, you are in a capital gain group. How are you going to transfer this gain and loss in such a way in order to achieve the group's objective? What was the group's objective? Please go back and check again. Go here and check what is the group objective. To minimize installments, payment by installment. That means you have to reduce your threshold below that limit. In such a way, you have to adjust your losses and chargeable gain. You have to transfer gain to someone in such a way who are paying in installments so that their profit reduces and losses also. That is the question. Fourth, relevance to the group's objective. What is the group objective? To reduce your installments, right? Corporation tax by installments, that is the objective. So the relevance to the group, the specific information provided in the schedule of information. They have given you some information in exhibit 1. On each information we'll comment. And all of these 4 requirements is worth 11 marks. Okay. So first we'll finish with this before we move on to the next requirement. Why? The reason is if I read all the requirements is very confusing for you. You might forget what I've read first and second. So first we'll finish with attack just A. So for that we don't need exhibit 2. I'm not going to read exhibit 2 at all. Exhibit 1, yes we need. So first this is your exhibit 1. Here is the parent. Here has Lodi, Neval, Orin, 13 owned 100% owned companies. Okay, so that means there are 13 companies in it, all are 100% each, and maintain. So this is falls under capital gain. Why? 75%. This also. This no. Orin will because it's less than 75. This 13 companies, all are 100. So all 13 companies will also be there in the group. And what about this? It is Lodi's 75% company. But what about here? If you take 90 into 80%, it is 72%. Okay. So effective interest has to be greater than 50% for capital gain group. I'm talking about effective interest. That means 90 into 80. This is 72. This has to be greater than 50%. So because this is greater than 50, even this also comes in the group. So how many companies are there? Lodi 1, Manet 1, Naval 1, 13 are here, including the parent. So 1, 2, 3, and 13. 1, 2, 3, 13, 3, and 1. 17 are there. Why have they taken 18 then? Hmm. Okay, they are taking. See, Orin is not a part of a. Orin is not part of a capital gain group. But when it comes for your corporation tax by installment, when you have to take the associate company, Orin comes under associate companies. Orin is an associate company. So that's why this is Orin also you take 1. So 17 and 1. So here Lodi, Naval, Orin and 13. 1, 2, 3, 13, 16, 19, 17 and here 18. So total 18. This is how you get the 18 companies. Okay. Now let us go through the general information. All companies are resident in UK. Thank God. All have 31st December each year. Very good. All TTP figure takes possible rolled over relief claim. Okay. None of the company have received any dividend income from non-groups. This information you need for professional skill marks. None of the company have received any dividend from outside. Good. Why? Because for your augmented profit, when we are taking the payment by installment, we need augmented profit. There we add the dividend that we have got from outside. Here, no dividend received. Your work is much easier now. All you have to take is just take the TTP, divide by 80. All companies pay corporation tax at main rate. What is the main rate? 25%. That's good. So now we are going to read information about Manet. So see, a requirement asked you about specific information. That was the last requirement in part A, if you can recall. So these are the things you have to comment. You have to talk about Manet, specifically Newled, Orin, and other 100 owned companies. So your requirement A stops here. Up to this, you need your requirement A. Your requirement B is about group restructuring. It starts from here. So we are not going to read group restructuring yet. Keep it there. Usually, this is the technique I follow. Whatever is relevant for a specific requirement, I read only up to that and I start doing the question rather than reading the entire case study. Some of you might adapt the other way. You might read the entire case study, all the requirements, and then you start to do A, B, C, D, or in any order. If you feel you can do B without A and like that. Some questions are like that. So it doesn't matter. Any method is fine. So let's start with A. Okay. So before I go through, I will straight away take you to this one. Okay. So this is about group planning. Okay. First one is, what is it? You have to reduce your corporation tax by installment. First, you have to find out when they have to pay the corporation tax. The threshold you have to find out, right? So here, TTP. If your TTP exceeds this amount, how? See, what is the upper limit? 1.5 million. This is the limit. If you are beyond this, if your TTP exceeds this 1.5 million, remember this figure. When I explained to corporation tax, I told it this figure in my corporation tax lecture. So if it's greater than 1.5, you pay by installment. But here you have to divide by 18. So we divide 1.5 by 18 and get this answer. 8, 3, 8, 4 threes. So if your TTP exists this, you pay. Okay. You have to check for 2 years. What is it? Either you have to have in 31st December 23 or 31st December 2024. Your TP had to exit. So 31st December 2023, your TP has to exit this, the amount which we have just got, 1.5 divided by 18. They have shown you here also, 1,018,000. Okay, that is for 31st December 2023, or this is the previous year. Okay, this is if you are going by this year ending 31st December, year ending 31st December. So TTP, you have to take 10 million, divide by 18. You get it? So 10 million divided by 18 is, this is the figure. So if your TTP is more than 843s in 31st December 2023 or more than 5555556 in 31st December 2024, or you see the or condition, this or that, you have to pay by installment. These are the fixed figure. This, you might ask, how we, ma'am, how did we get 1.5 million or 10 million? These are fixed figure. It's from your notes. Go back to corporation tax in my lecture. My lectures are there for free, ATX lecture. By the way, it's there for everyone on YouTube. You can go and check. It's there still. Check this. These are the rules you have to know. Okay. So with that, we have finished the first part. Remember, there are 4 parts in A. So the first part, you don't have to write obviously the first part like this. Because this is just a note, just writing a subheading like this is enough. First is done. This is the first, done. Just a small part. Okay. Next. Next requirement was this. You have to identify the capital gain group. Okay. First, what do you have to say? You have to talk about subsidiaries. 75%. 75% subsidiaries you have to mention in your answer. And if they have an effective interest of greater than 50%, that also you have to include in your answer. So here, the group will consist of Hair Limited. It's 75% subsidiaries. That means whoever it's 75% subsidiaries. You don't have to mention each. If you want, you can mention each name also. It's up to you. And 75%, and they are 75% subsidiary. But if it's they have 75% subsidiary, remember the effective interest has to be more than 50%, which they do not directly own. So if you see this table here, this one, Hair does not directly own Manatee. He owns it through Lodi. Okay, Lodi is 95%, 90% subsidiary of Hair, and Manet is 80% subsidiary of Lodi. Both are 75% subsidiary of each other. But if it comes to Manet, if you take 90 and 80, it is 72, more than 50. So Hair has more than 50% of interest in Manet, indirect interest. That's why it is also taken. Okay, that's what is written here. So all of those companies will come there except one company. Exception is Horin. Except Horin, and it's a single capital gain group. Why? Sometimes you can form multiple groups. Remember that. This is very important. You have to distinguish between single and multiple. Thank God, luckily in this question is just single gain group. All of them are in one. Okay. Now, so the second requirement is answered, done in part A. Coming to part 3. Okay. What did they say? How are you going to transfer your gain and losses among the group in such a way that your corporation tax by installment reduces? So they have given you 3 aims. Under third one, of course, we have another 2 part. So 3 aims are there. First, very easy. Reduce the TTP of the company up to this amount. Do not let them exit more than this. That's why you have to do the first requirement first. Why? Because this figure you have calculated in the first part of A. If you would have not done it, you would have not been able to answer this also. How much of capital gain or loss should transfer? You don't know if you have not calculated this. Okay, so reduce your TTP of this amount, then you don't have to pay the corporation tax in installment. Second, reduce the TTP of those companies which are still required to pay corporation tax in installments, as they will reduce the amount of each installment. They might be paying in installments, but at least their installments will reduce. First aim is they no longer have to pay corporation tax at all. Earlier they were paying in installments, but you have reduced the TTP up to such an amount. Now they don't have to pay corporation tax. Another scenario, second scenario talks about you are paying in corporation tax huge amount. Now you are paying lesser amount because you are reducing your TTP. Because you are not able to reduce your TTP so much that you bring it to zero. And the third one, either you transfer whole or part of your gain or loss between companies in a capital gain group. But remember two things. Your gain and loss should be transferred to match them against each other. Gain and loss should match against each other. And second one, your gain should be transferred to a company which has TTP in excess of this amount. If it has less than 833, you are not anyway paying by installment. So no use of transferring a gain to such a company who anyway has TTP less than 83,333. Any company having more than 83, let's say a company is having 100,000 TTP, to that company better to transfer the gain. Okay, so that your TTP reduces below the threshold. So three parts are done. This is the third part of your requirement A is done. You see how you are writing the subheading one after the other. Next, the last one, relevance of specific information. That's what they have told. And they have given you 4 companies, starting with Manet, Orin, Newell, and other 100 own companies. In that order only we'll talk. Manet. Okay. So we'll now go back to Manet and we'll read what they have to talk about Manet. See, this approach is easier because you can quickly recall what you have just read. For Manet, only one line of information that their TTP is between 40 to 50,000. Now we'll see whether they have to pay by installment or not. So Manet, if you see 40 and 50, so their TTP is less than 83. Because it is less, they don't have to pay also by installment. In this year they don't have to pay. But in this year, if their TTP is more than this, they have to pay. Okay, unless it's TV, so they have to pay. Now, what should you do? So you have to transfer, other companies have to transfer their chargeable gains to Manet. Not Manet has to transfer. Other companies has to transfer their gains to Manet so that Manet's TTP is kept below this limit. Okay, just read once again. Every year they have 40 to 50,000 TTP. So we don't know the exact amount when it will exit. Now, so Manet is done. Next is you have to name the company like this, Newell. So for Newell, this was acquired on May 2023 and it has a capital loss brought forward as at 1st Jan 2024 of 94,000. This loss arose on a sale of land, this one. See, please understand, whenever you are given a loss, understand whether it's a pre-entry loss, after the accusation or before the accusation. Is very important. If it's after accusation, no worries. Normally you can transfer the loss. But if it's pre-entry, before acquiring the loss you have incurred, there are restrictions. You can't adjust it. So this loss of 94 arose on 1st Feb 2021 and you have bought it on 1st May 2023. It's a pre-entry loss. Pre-entry loss you can't transfer. This is what you have to write in UL. This is what you have to identify and specifically write also. You see, pre-entry capital losses. What type of loss? Mention that is a capital loss. It could be trading loss also sometimes. Some question. This is capital loss. So because they were realized by the company before Hair Limited have acquired them, you cannot transfer it to your other members in the group. Done. That's it. 1 point is enough. Coming to Orin Hot. So Orin has TTP exists 200,000 every year, and they make a gain of 86,000 chargeable gain. Year ending 31st December 2024. So we'll see Orin. Sorry. I always say Orin, it's Orin. So clearly it's 200 means TTP exists 83,000. They have to pay by installment. But remember, Orin is not a member of the group. Many of you forget this. Immediately they start saying you have to pay by installments, give the losses to Orin. No. Neville cannot transfer his losses because pre-entry loss. Orin cannot transfer their gain because not part of a group. They are not part of a 75% subsidiary of Hair Limited. So you can't reduce his TTP also. Orin has to pay by installment. Now coming to the other 100% owned companies. We'll read about this. And after this we are done with A and we'll move to part B. So each of this TTP has more than 130,000 every year. 4 of them have gains. 5 of them have capital losses. Okay. So now, first we'll talk about this thing. See, they have beyond the threshold. All of them are required to pay corporation tax in installment. And what about gain and losses? Their gain and losses should be transferred to other companies. How? In accordance with the guidance set out above. For writing this, you are going to get your professional skill marks. How? You are linking it to what you have written above rather than repeating the same thing. What guidance? You have to set your capital gain and loss in such a way. Go to requirement 2. I'm sorry, 3. You said you are going to reduce it in such a way. Objective is what? To reduce your corporation tax by installment. So we told we are going to give it to Manet. Isn't it? Gain should go to Manet in 2024. Okay. Now, done. So part B is group restructuring. Now, coming to part B. First, we'll read the requirements. Is 4 marks. Okay. Here. So you have to identify with reasons. Wherever you have to identify, first write the point, then give reasons. Implication of the proposed group restructuring. There is some group restructuring going on in relation to chargeable gains. 3 things are there: chargeable gains, stamp duty, land tax, capital allowances. Okay. And what will happen to any capital losses belonging to the 5 companies whose trade and assets are transferred? How many things are there? Gains, stamp duty, land tax, capital allowance, and capital loss. 4 things. Each one is for 1 mark. That's why you're getting 4 marks. So first we'll go through group restructuring paragraph in exhibit 1. Oh, it's a very small para, just 3 points. So this is about the 5 group companies. Remember the ones who are making the loss, just 5. They are making loss. They are selling their traded assets. Okay. So the Naval, because Naval also made a loss, and the 4 other 100% will be sold to Lodi at some point in Jan 2025. This is something new. Okay, this part. Assets of the 5 companies, including business premises, machinery equipment, will be sold to Lodi for their market value. And the tax written down value of the main pool of each of the 5 companies immediately before the sale will be 0. So let's talk about that. pick each one each. Okay, so first we'll talk about the gains. Divide like that. Subheading like this you have to write. First group structuring is the main. Under the chargeable gain, under the stamp duty land tax also, under the capital allowance also. First write the subheading, then you can fill in the blanks. And capital losses. 4 things. So first we'll talk about chargeable gain. Remember, any gain and loss you are transferring, they told at market value, right? It should not be at market value. Why? Because it is, you are transferring it among the 75% subsidiary. So it's at no gain, no loss. All your assets, including business premises, will be transferred at no gain, no loss. That no gain, no loss, for writing that you're going to get 1 mark because it is among the 75% subsidiary. So that's why no chargeable gain will arise. Very simple, one line, 1 point. Stamp duty land tax. See, because this is among the 75% group, no stamp duty land tax also. Capital allowances. This is because you are selling it among the 75% group, it is transferred at tax written down value rather than market value. They told at market value. No. Capital allowances at tax written down value, it will be transferred. Your machinery and equipment. So that's why, because this is not a sale to an outsider, no balancing charge will arise. Done. Capital loss. What about the unused capital losses? See, there was an unused capital losses. Naval was not a part of a, sorry, Naval had capital losses and also the other 4 companies. But will not be transferred. See, for writing this, that it will not be transferred to Lodi. You're going to get marks. This will not be transferred to Lodi. Unused capital losses cannot be transferred. But the current period capital losses, you can transfer as set out above. In the same capital gain group, you can transfer, but not the unused capital losses. We are talking about the unused capital losses. Wait a minute. Exhibit. Let me go to Naval again. Yeah, this is in Jan 2025. Naval. So Naval has capital losses brought forward from 1st Feb 2021. You see, this is unused. This 94,000, you can't relieve it. This is what we called about unused capital losses. But current year capital losses, you can transfer. This is what you have to write. So it's done. Even this is done. So come into the third C, 5 marks, ethical question, disclosure of transfer pricing. Part C. Part C, nothing is there in Exhibit 1. Nothing has been written. Everything is written here only in Exhibit 3. So read this 2 para and answer it. 5 marks. All ethical questions are worth 5 marks. Definite question, 100% you will get ethical. And if you see the ethical answers, they follow a specific structure. Please follow it. So here, management are feeling that transfer pricing should have been adjusted in respect of the year 31st December 2020 for the 3 of the companies in the group. And because of this, corporation tax is understated. As a result of non-disclosure, they did not disclose this. See, penalties and interest has already been discussed. So you can't include this in your answer. Okay. Other matters you have to discuss. Okay. That needs to be considered by the tax advisor as a tax advisor to the group and by the management of the group in relation to disclosure or non-disclosure of information to HMRC. Specifically on this. So there is a way you start ethical question. I will take you through that. First, please identify the date. Whenever there is a penalty that you have not disclosed something, always check whether it's more than 3 months, 4 months, 5 months, 12 months. Based on that, you have to explain. So because this is more than 12 months, if you say it's 31st December 2020, since the return filing date, because it is more than 12 months, what is it? If it was less than 12 months, you could have amended your corporation tax return. There's a date for that also, when you can amend your corporation tax return. If it's less than 12 months, if any disclosure, non-disclosure, or an error took place which is more than 12 months, you can't go back and correct the error. So it's too late to amend the corporation tax return. You start from here. Okay, what do you do when you cannot adjust, when you cannot amend? You disclose it to HMRC. So you are a tax advisor, we should encourage the group to make this disclosure. This is 1 mark. Okay, you can help them to make the disclosure. Second, they also told the management, next step from here, follow this order. This order is fixed. In any question, it's all fixed, except the question is different, company is different. But first you need to disclose, then you have to tell management to disclose, right? So the next is management. Focus on management. They can inform HMRC or they might authorize us to do so. But we must not disclose the error to HMRC without permission. You need the permission. If you don't get the permission, you can't disclose to HMRC. This is the second point you have to mention. It's always like this. If you see any question, pick up any past paper question, you will see this pattern. First, you need to disclose. You have to make the encouragement to make the disclosure to the company. Second, you have to tell the management to either they need to disclose, either you have to get the permission from them to disclose. Next, third step. We cannot continue to act unless disclosure is made. This line is also fixed. Then the fourth is this. We should notify the group of the following consequences of not providing information to HMRC. So you have to tell the group, if they do not make the disclosure, what are the consequences. This is the fourth and this is the fifth point. What is it? This is fixed. These answers are always repeated. What are the consequences? These consequences are also same. These two consequences. First consequences, you will advise, you will no longer add for them, but you will not give any reasons if they refuse to disclose the error. And non-disclosure of error leads to tax evasion under both tax and money laundering, and it could result in criminal proceeding also. So these are the last step. You should inform money laundering officer, and you should also ascertain whether this non-disclosure occurred to other matters also, not just transfer pricing. You have to also check whether there were other areas also where non-disclosure has occurred. Okay, this will give you professional skill marks, skepticism skill. You are questioning them. So this is done. Part B, minimizing income tax on investment income. This is a difficult section. It has a lot of things for you to do. For which we need exhibit 2. So we are done with exhibit 1 completely. There are 3 things to do. Under 3 things we have a lot of, third one we have a lot of things to do. So first we'll finish with first and the second one. You have to minimize income tax on investment. Okay, shares are having 4% return, cash are having 1% return. Okay, now either hold 450, there is an amount of 450,000 for you to invest. Okay, D will pay any capital gain tax due in respect of the sale of the London house out of our existing fund. So we'll read the third one. You need the third one. Now, remember, they have clearly told you none of this investment are under VCT or EIS scheme. Okay. Now, so what do you have to do under third one? They have given you the points. First point, then second, and third. There are 3 things you have to do under third one. Okay. This information you need for you to carry out the third. Part 3. In your calculation, you need this 4% also, 1% also, and this amount. 1 and 2 are not specific requirement for you to do. Your requirement falls under 3 only. Only the third one is the requirement. So under that 3, these are the requirements. 1, 2 and 3 requirements under D. For that you need 1 and 2. Okay. So now calculate income tax savings. See, whenever they say income tax saving, do not calculate the whole income tax table. This is where most of the students make the mistake. You have to save your time. You have to work on the difference, marginal. Calculation of income tax saving. Okay. If D gives 150 to CAM, rather than investing this 450, D will invest 300, 150 will be invested by CAM. Okay. Next, they have also given you some advice. They have hinted you. They have given you advices. This is hint. They are helping you. Examiner wants to help you. They are very kind enough to help you. Otherwise, you will not know how to start, where to start. To do this question efficiently, you should just calculate the additional tax payable by D and CAM on the income generated by inherited funds rather than preparing complete income tax computation. They have told you also. They have hinted you also. So do not do the mistake. Next. Addition to that, to save your time, they have already calculated that if D invests the whole 450, the tax is 5004. Okay, in terms of bank interest and dividend income, the additional income tax liability. So the income tax is 5004. So you don't have to calculate it again. You only have to calculate if D pays 150, 300, sorry, if D goes for 350, sorry, 300,000 and 150,000 out of this 450 is done by CAM, is invested by CAM. Then what is that tax? How much tax you can save? But if D invests the whole 450, tax is 5,400. So this is your starting point, 5,004. Next, you have to do. Okay. So the next, it seems to me that further you can further reduce your income tax liability by this. So rather than giving 150 to CAM, D giving 150 to CAM by selling the house, that proceed of that house, invest 2/3. 2/3 in shares and 1/3 in cash. Okay. 300 in shares, 150 in cash. This will be split in 2/3 and 1/3. Okay, so now here what is the requirement? Set out the factor which are relevant to obtain more income tax efficient split of the total investment. How can you split your income in such a way that it becomes more income tax efficient? You have to set out the factors. You should only consider income tax positions of D and CAM. I do not require you to produce calculations of any potential tax saving. Here you don't have to do any tax saving calculation. You only have to explain. And the third requirement, this is regarding a gift of 20,000 to Oder. Oder is the son of D. So the matters to consider in relation to income tax in respect of a gift to Oder of 20,000. What is the impact on income tax? All three requirements are for 11 marks. So you need to go to Exhibit 2 and read. Okay. So here, Exhibit 2. Exhibit 2 is for both requirement C and D, by the way. Sorry, D and E. So here, it's about D. Okay. Resident and domicile in UK. Good. My husband came, so both are husband wife. Moved in UK in Jan, married in this one. Cam is resident in UK but domicile in country of Rivaria. You see, non-domicile spouse. And they have a 16-year-old son who is resident and domicile in UK. Now, father's London house. So they have inherited a house. Father died on this date. They have inherited this London house. Probate value of the house is 390. Now it's worth 450. Father purchased it for 130. They intend to sell it. Now, so those 450 is divided 300 and 150. Now, these are the alternative investment plan. Already I have explained this in the exhibits. Exhibit 3, in the requirements they have told how they are going to do. give 150 to camp, leave 2/3 of shares and 1/3 in cash. So it's repeated. I'm not going to waste my time to read it again. Now give to order. So this is about a cash give of 20,000 impact. Okay. And they have given the annual income. So now they have annual income, bank interest, dividends. Okay. D and CAM. So by looking at this, looking at annual income 170, you know, D is an additional rate taxpayer. Additional rate taxpayer. And looking at CAM is a basic rate taxpayer because 18,000. This information is given for that only. Okay. So now straight away we can go to part D and answer it. We have all the information, isn't it? So now first gift of 150 to CAM. First we know what is the total income of D if D invests 450 and dial is 5,004. From here how much you can save, you have to reduce it. For you to do that, you see below, you need this figure and this figure. It's shown here and here. So first we'll go by D. If D invest, you have to write like this, proper subheading like this, okay? D invest 300,000, CAM invest 150,000. Okay? So there are two types of, see, they have told us to work on interest income, additional only, interest and dividend, not employment income. Do not touch the employment income. So interest and dividend. They have given you the rate also. For interest, for shares it is 4%. Shares is for dividend. And whatever is for cash, that is for interest, 1%. Okay. So D is investing 300,000. How they told? 1/3 for cash, 2/3 for share. So that's why 300 into 1/3 and 300 into 2/3. This is dividend income is for shares. This is for cash. Interest income is cash, 1/3. And then because D is an additional rate taxpayer, 40% for interest income. Interest income is at non-savings rate, 20, 40, 45%. And it's 450. This 1,000 is, by the way, the result of this. But I'll show you with the highlighter. It is the result of inside bracket. 300 into 1/3 into 1%. You get 1,000. On that, if you take 40% tax, 450 is the tax. We are working on tax here. Next, with that, add the dividend income of D. So dividend is 300 because D is investing 300 only. Shares is 2/3 and 4% is the yield that you are going to get. It's 8,000. Remember to minus the dividend nil rate band of 1,000 irrespective of your income. 1,000 deduct. Because additional rate taxpayer for dividend, additional rate taxpayer is 39.35, highest tax. Add together this one. Now coming to CAM. CAM is also everything is same except this is 150, this is 150. So this fraction remains same, 1/3 for interest, 2/3 for dividend. This is 1%, 4%. No savings income nil rate band available here. Why? It has been utilized. 150,000. It does not fall in the first 5,000. If you see your non-savings, okay, it does not fall in the first 5,000. So savings income nil rate ban is gone, but dividend nil rate ban you will get. And because CAM is a basic rate taxpayer, 8.75. Okay. So 263. So you add 3205, 263, deduct it from 5,400. This is your income tax saving. Okay. Now that's over. You have got first part is answered out of the three parts in D. Now they have told the factor. So how many factors are there? Just three factors are there. 1, 2, 3. Please do not write numbers. Do not write in bullet points, but write subheading like this. Make it bold, write a point under that. Write a subheading under that, make a bold, leave space when you are giving each point. Tax allowance is 1 point, income tax rate and yield on investment. So when you have to make a tax efficient split, you have to check the tax allowances. Okay. What are the factors? See, factor is Cam might get a tax allowance of 500. How? Savings income nil rate band. Why? Because he's a basic rate taxpayer. He's a basic rate taxpayer. That's why. But D will not get that. Not in this question, but we are talking about factors. Okay. Next is income tax rate. If you check the income tax rate, Cam is paying lower tax rate than D. So it makes sense that you maximize Cam's investment and minimize D's income. Third, yield on the investment 4%, 1%. If you check, because Cam is having more investment and shares is giving you more. Shares is giving you 4%, whereas interest is just 1%. So make Cam invest more in shares because 4% interest. Make D invest less in shares. This will change their income level. Okay, so that's it. We have answered that part as well. The last part, give to order. This is very tricky area. See, they have given you the age of order less than 18, no? This is a child. You are giving a gift to a child less than 18. He's 16 years. Somewhere it's written there. And you are giving a cash. So we are talking about interest income. What was the cash? 20,000. How much it will yield? 1%. So 200. So this income, interest income that he will receive is 200. If you remember, a gift to a child benefit charge arises. This gift exists 100,000. So if it exists 100,000, it will be taxed as D's income. Until order is 18 years old, he still order is 16. He's a child and he's having an income of more than 100. That's why it will be taxed on D rather than order. All of the interest income, not just the excess over 100, not just 200 minus 100. No, the full 200 will be taxed on D as D's income because order still did not turn 18 for him to be treated as an adult. Okay. Once order is 18, then that interest income will be on order treated as his income. Okay. And if you see order, because it's just 16, it's very unlikely that he'll be an additional rate taxpayer. So that's why interest income would be taxed lower under the hands of order compared to DD is an additional rate taxpayer. Okay, so in that case, it will reduce the total income tax of the family. Now the last part, gift to Cam inheritance tax impact. You have been given the probate value, market value, domicile, deemed domicile, all those things, right? We'll read here. How many? Two requirements are there? 1, 2. 9 marks. Not, you might ask, is this 9 mark? No, both are total 9 marks. So by reference to domicile status, explained the gift of 150. How can this result in inheritance tax liability and how you can avoid this? Okay. You should note that D gave Cam half interest in her home on 1st August 2020. Value of this gift was 600,000. Next, calculate capital gain tax saving. If D were to give Cam 1/3 interest in London house before the sale, as opposed to 150,000 following its sale, rather than giving 150,000 cash after the sale, give the 1/3 interest in the house before the sale and show the impact on the capital gain tax saving. 9 marks. So here we have read entirely. I think we have finished reading exhibit 2, right? Probate value is 390, worth is 450, house was purchased as 130, and remember, spouse exemption will not come because they are non-UK domiciled, one spouse. So that thing you have to remember answering inheritance tax. So here is the calculation of capital gain tax. This is the first part. First part is inheritance tax. Okay, if you see here, Cam is non-UK domicile, so spouse exemption, okay, is limited to a maximum of 325. If you are a non-UK domicile spouse, your maximum exemption is 325,000. But if you see, they have made a gift of 600,000. So already this limit has been exceeded because of the gift made on this date. And D's gift of 150 could be pet, which would give rise to inheritance tax. If D were to die within 7 years, you have to write all those things. How inheritance tax could arise. You have to talk rather than calculating it. Okay. So it's a pet. If he dies within 7 years, inheritance tax liability will arise for that 150,000 gift. Now, but you can avoid it in two ways. They have also told you this part of the requirement. If you don't answer, you are not going to get full marks. What is it? Deed of variation. Father's deed could vary. You can alter the father's deed. D's father's will you can change. How? Leave one-third house directly to Cam. Rather than D's father giving to D, then D giving to C. D's father giving to D, then D giving to Cam. Rather than avoiding, this becomes a pet. So to avoid, and this can be chargeable if D dies within 7 years. To avoid this, D can give directly to C one-third in the house. Change the will in such a way so that you don't have to make this pet any longer. Next, you can treat Cam to be UK domicile so that they can get an unlimited spouse exemption. Everything is exempted, not the 325,000 limit. Now, coming to the last part of the requirement, capital gain tax saving. If you give one-third interest. First, see, when we are finding the sale, this is the market value, this is the probate value. Okay, we deduct the probate value from this and get the chargeable gain 60,000. And this is CGT. Do not forget annual exempt amount of 6,000 deducted. Because D is an additional rate taxpayer, CGT is at 28% and it's a residential property. You're selling a house, not 10-20%. That's where the highest 28%, and then you are giving two-third, one-third. So two-third of 60,000. This is gain. So chargeable gain you are dividing. So 60, two-third 40,000 goes to D, one-third 20,000 goes to CAM. Then get the annual exempt amount 6,000. Annual exempt amount will be 6,000 for both. Then for D is 28%, CGD, for CAM is 18% because basic rate taxpayer. And then what is the CGT saving? See, earlier D was just paying this amount 15. Now both of them are paying this, so deduct the difference. This is the CGT saving 3080. Okay, now so that's it. We have finished the entire lecture. Now before I end this, I am going to take you through some key answer tips on answering this question. So as I told you, question A test corporation tax, ethical, income and capital gain tax. Okay, better to answer first in the order given. And remember, capital gain group is a very important topic in your exam. Transfer of trade and asset is not often tested, but you have to be prepared for anything which had not been tested before. Part C is very straightforward because it is about non-disclosure of to HMRs about transfer pricing. And D, do not do unnecessary calculations. Already income tax by D has been given. Okay. And also consequence of gift to a minor child. This has been tested. Usually it's not tested. Then you have been given non-domicile spouse. So here when we got through the corporation tax, okay, so you can read the top tutorial tips in between the answers. It will help you a lot. So next, so all the things what are there in the tutorial note I've explained to you. So there is nothing that I think I've missed out, that I'm still going over it. So now basically I have explained everything. Now let us go to the examiner's report and mark the few important areas and tell you areas where you need to be more careful and pay more attention. Okay. So one of the mistake students made is in the capital allowances. They told in the question it is transferred at market value, but do not forget, if it's under 75% common control you're transferring, it will be transferred at tax written down value. This candidates had often missed out. The technical error often repeated by students. Third part, ethics, was done well. And coming to the last part, so take your time and read this. Most of the things I've explained here. So not much to explain. Not new, not a lot of new things are there. So now coming to the marking scheme. Requirements to pay by installments, let's say 3 marks, definition of capital 2 marks, amount of transfer, specific information for each. Okay, 1 mark for each relevant, and the need to disclose and other matters, income tax saving, factors, and give to order. 3 things are there. And for E, what could be the liability and advice? The 2 advisors that treat as UK domiciled and transfer 1/3. So transfer 1/3 and CGT tax saving. Now professional skill marks. So here, if you go by the format, you will get your communication skill marks. Then not preparing complete income tax computation will give you communication skill marks. And analysis and evaluation. How did you use the information to make the most efficient use of gain and losses, to pay corporation tax by installment, which group companies are required to pay by installments, and you use the information to do calculations to arrive at income tax saving, and to consider the all tax relevant to inheritance and capital gain tax. Example, you have taken all. Skepticism, attitudes towards disclosure of transfer pricing, and critical assessment of the friend's advice. Commercial acumen, how you are going to split the investment between D and CAM, anti-avoidance rules regarding income of minor, and relevant tax planning, gift to CAM in party. So that's it for question 16, and I shall see you in the next question number 19, requested by a member again on my channel. So take care and see you.